RR does not matter. So your stops are constantly getting ran through, but you're trying to have the best RR possible. How do you do it? How can you improve your trades to where your stops aren't massively big and make sure that every trade that you go into has a good RR ratio? This is one of the most common questions that we get asked in our Discord when people first join, right? Should I go for a 1.5, a 1 to 2, a 1 for 3, 1 for 4? 1 for 3 seems to be popular. There's a ton of YouTubers apparently out there saying that your trades need to at least be a 1 for 3. So I'm going to talk about what we've seen from people that we know are profitable, what I've seen tens of thousands of trades at this point on TradeZilla, and what you should look for. I'm actually going to do this in the context of price action though, because that's really what determines all of this. So here's the theme of this video. This is going to be the shortcut. You can write this down if you don't watch the rest of this video. RR does not matter. Your trade thesis is what matters, and staying in the trade until your thesis is broken. The second point to that is no trade should break your account. If you keep those two things true all the time, you will have good metrics, whether it's profit factor, RR, or whatever it is that you're measuring. Those are all secondary to just being able to do good analysis and look for good entries. That sounds cliche and dumb, but I'll show you what I mean on the charts. By the way, if you're new here, go ahead, subscribe, like. We have a Discord where we day trade live every single day, 9:30 a.m. Eastern Standard Time until the market close, mostly trading futures. We're also prop traders. Many of us are, at least. And if you want to sign up for a futures prop trading account with Apex Trader Funding, use my code below. It'll give you 71% off right now. They're probably going to run a 90% off sale soon, and you can use the same code for whatever sale they're doing, whether it's 10%, 20%, or that 90% sale. Use the code down below in the description. Click that link and sign up today. Prop trading is one of the best ways to leverage your returns in the market. Let's get back to the video. Okay, so I did a video on this same price action called catching a knife. There was a knife catch down here where I did, and I actually went long right here at 940. You can see that was an amazing trade. I did a whole video on it, recorded it before this video, should be out before this video, so you go watch that video for how I did that trade. I want to talk about a different trade. Let's talk about this trade right here. Say you went long on this flag formation up here. I actually think on the 15 flag is right here. So let's go ahead and look at 1 o'clock. So 1300 on the 5-minute chart. 1300 on the 5-minute chart is right here. So at 1300, which is 1 o'clock Eastern Standard Time, I'll do an option V for vertical line. This is where we start to get this flag formation on the 15-minute chart. Now, how do we get a good RR trading inside of this channel that I've drawn, knowing that we're likely in a flag, or we suspect we're in a flag formation here? What is a good RR on this trade? Where should my stop be? Two things: your stop and your take profit determine the RR of a trade. The RR of a trade does not determine your profitability. And this is one of the biggest mistakes new traders make, is they say, well, I had a tight stop, I went for, 5 points and I had my stop at 1 point. So that's a 1 to 5. I'm risking 1 to try to make 5. Sounds great. Sounds amazing. The problem is, on a contract, on a product like NQ, your win rate is going to be like 1%, right? You're going to get stopped out because that's too tight of a stop. And this is what really breaks people's minds, is that if I want to go long here, suspect we're in a flag, and I want to go long on this chart, I'm going to go to the 15 just so we can see this. Say I go long here at this price of 16,995 right here. I go long here. Now, the bottom leg of this flag is about this long, and I would expect another move out of this price of the same length. So let's measure this move, measure this, that's the wrong button, measure this move, about 56 points, and let's measure how much higher we went, about 53 points. Go figure. So it's a proper measured move, it's a proper flag execution, and we saw on the 5-minute that it really just went up and then down, and then it exited, and we kind of drifted up here. So how much do I want to risk? If I suspect that this is a flag, a bull flag, how much should I risk? The question is, how would the price have to look for this not to be a bull flag? And that's where you put your stop. And that's the only place you put your stop. Most people mess this up. Part of that is impatience. So if you go here, if I go long here at the bottom of this flag, so we go here, I get the next candle here. I should suspect if this is a flag, if I suspect this is a flag, we should return to this low, which we did. You can see on this green candle, we should suspect we should return this low. So I'm looking to long right here around this price, right around the 16,995.25 price, as close as I can, as absolutely close as I can. What a lot of people do is they get impatient, they suspect it's a flag, and they get an entry right up here, right around 17,010 or something like that. Let's say you go long at 17,010 and I go long at 16,995. So let's mark these up. This is you, boom, bam, and down here, this is me. Now, this is the same trade, technically. This is the same trade. I mean, you're probably going, no, Forrest, it's different entries. It's not the same trade. No, it is the same trade. It's the same thesis. My approach to the market is, we have a thesis, you execute the thesis. The better you execute the thesis is how you make money. This is the same trade. And when we call it trades, I see this all the time because people they'll get in late or they'll get in early which is probably the bigger thing, is people will get in early and they won't wait because they're afraid the market's not going to come back to their entry. Well, it will. If you get in at 17,010 and I get in here, our stops have to be in the same place. And I'm going to say that again. The proper stop is where this stops being a flag. So for this to stop being a flag, I might give it a little wiggle room below the bottom wick of this right here at 16,985. 16,985, we do option J. This stops being a flag. At this point, we're probably, if we came down to here, we're probably hitting the bottom of this channel and doing something else. Now with the power of hindsight, we can see that that didn't happen. But that's where I would put my stop at the most. Really what I would do if this is my long is I'm putting my stop like right under the bottom of this wick, right under the bottom of this wick, because flags don't form outside of that. It's some other price action. And if I get stopped out, that's fine. I'll reassess. But you can see here that this is a 6 points. This is 6 points. 6 points. I'm risking 6 to go for the execution of the flag, which would have been, again, 53 points. Risking 6 for 53. The RR is whatever that is. It literally doesn't matter. We'll do the math. We'll do 53 divided by 6, 8.8333. Every point that I'm risking, I'm making 8.33 points. Cool. That's a great RR. If you went long at 17,010, so 53 minus 10 is what, 43. So you're going for 43 points and you're risking what, from 17,010 to 89. Can't do that math. 17,010 minus 16,989. I missed 16,989. It's 21. So you're risking 21 to make 43 with your entry, with the worst entry. You're risking 21 to make 43. Crazy how difference of RR is. That's like 1 to 2. For every point that you're risking, you're only making 2. So we have a 1 to 8 versus a 1 to 2 on the same trade based off of the entry, but your stop has to be the same. And that's what's so key about this, guys. Let's do another example. All right, let's get rid of all these lines. These lines are all over the place. All this crazy random math that I just did. So let's say that you went long down here. Maybe you missed the initial long that I talked about in my other video, catching the knife, and you're looking for a double bottom. You're looking for the double bottom entry around here. Now, it wasn't a perfect double bottom. Okay, so you can front run the double bottom, which is fine. You can start to scale in, which is fine. However you do it, you start to scale in because you don't want to miss the fast bounce. You know that double bottoms are pretty fast. That's just how the market moves. Where are you putting your stop? Well, I'm putting my stop anywhere where it stops being a double bottom. I don't want a lower low formation. If we zoom out here, we don't really have any trend lines or anything that we can mark this off of, but we had a huge amount of red. So there's two things that I'm looking for in this trade. The first is, what is the volume on this red? If we have a huge amount of volume here, which you see we don't, it's falling off. We had a huge amount of volume here. I'm probably getting out the way because that looks like we're going to do a lower low situation. So I'm watching the price action acutely to make sure that we are actually possibly going to get a double bottom. We see that we actually had a nice doji formed, which is cool for that thesis. But I'm putting my stop like right here, right down here. Anywhere in this area, the lowest, I might risk like, maybe 10 points at most here. But you put your stop where it stops looking like your trade. You don't put your stop based off your P&L. You can say, well, I only want to lose $20 today, so I'm going to put it 1 point down here at 38. That's unacceptable. You don't get to trade like that. You have to trade your thesis. You have to account for the normal behavior of the market, and you have to be patient. Your RR is a byproduct of your trade. Your RR does not determine your trades or your profitability. And I want to say that again. Okay, your RR is a byproduct of your trade. It does not determine your profitability or anything like that. One of the things that you can do is you can look retroactively at your RR, your average RR on trades, figure out which ones are really, really good, and then analyze those trades to figure out why they were so good. And that's how you use those metrics. It's a better way to use those metrics. I'm not saying that you can't have hard and fast rules where you only risk 5 points and things like that. I did that for a while where every single trade I only risked 5 points. And I did that experiment. I did that for like 2 months actually. I told everyone in Discord I was doing that. Every single trade I did, I was only risking 5. And that was to force myself to get better entries. Now the benefit of that trading style is that you're only ever going to lose 5 points. And so you can predict how many at-bats you're going to get in a day before you hit your acceptable max loss in a session. A lot of people do that. That's fine. What I'm going to let you know though is that you can't look at your RR as a driver of profitability. The only thing that's going to determine if you're profitable or not is your entries, right? How good you are at entering and how long you can hold your runners is going to determine your profitability. If you look at any given trade and you move your take profit and you move your stop, the RR changes completely. It's completely irrelevant. The only thing that actually matters on your trade is the entry and the exit for profitability. Profit expectancy and profit factor is a huge variable that you can look at on your trades. That is how much money every time you get in a trade are you likely to make. TradeZilla, they don't have it up on this video, but it will tell you what your average trade expectancy is. So every time I get in a trade, I'm likely to make $250. That's the average of all the trades. It's a better idea of the profitability of your system versus, thinking about RR. Stops, and I'll say this again. Let's say I go short. Do one more example. I go short up here at 17,050. 50. I think this is a pivot. I think we're going to sell off into the first standard deviation lower band here. Okay. This actually was a short that we took. I took this on my phone. I just remembered. I went short like four in key. It was actually a crazy trade. Was I at the gym? I think I was at the gym, but I took this one on my phone. I didn't take it on my Apex accounts. I just did it on my personal account. So went short. And where would my stop be? If I think this is a pivot, my stop at most is going to be outside this channel. So this channel is not really perfectly drawn right now. Tidy it up a little bit right here. My stop, if I think this is a pivot, I don't want it to run above here. Now this is a higher trade. We were looking at bookmap and everything like that. We were kind of anticipating this thing rounding over. This was also the end of the measured move of the flag. So there's tons of TA and analysis that goes into this. But my stop, if this is a pivot, if I'm anticipating a pivot, is keeping this very, very close. I believe this was a cam pivot as well, right around this price. But on this trade in particular, I had a very, very tight stop. And it wasn't because it was higher levered. It's because of my thesis. Like either this was a pivot or it wasn't. If this wasn't a pivot at this time in the day, we were going to run, right? The likely scenario, if this isn't a pivot with a high volume bottom wick, this is almost a doji, is that the market runs, we break this channel, crack VWAP, and we sweep. Ladies and gentlemen, what do we sweep? Overnight highs. That's the most likely price action is we sweep overnight highs or we sell off into VWAP and do something else, right? Those are the only two scenarios. And so part of trading and having a thesis is understanding what the likely outcomes of the current price action are. And at this point in time, that was it. It was either pivot or we go for the sweep. We erase the day, go for the sweep, and we start thinking about what is the daily candle going to close based off of the timing and the volume of the market at the time. So when you're handling your stops, if you're a new trader, it's totally fine to have hard and fast rules about stop management. And I think that every trader that's a newbie should use stops. Everybody should use stops. It's never a bad idea to use stops. Sometimes I don't, but it's never a bad idea to use stops. Like it just never is. You might get stopped out. That's fine. You re-enter. You just have to understand that what a stop does for you, how they work in a trading system, and what RR actually will do for you in a system. I have no idea what the RR is in my trades. It's not even something I think about anymore. I used to obsess about it constantly, which is why I'm making this video, because I was in the same place that a lot of people are that are asking me like, hey, what's a good RR on a trade? I used to think that I had to, when I would look for a trade, it's like, oh, this has to be a 1 for 3 or I'm not going for it. That's silly. If I know the market's going to go from A to B, then I just trade A to B. Doesn't matter if it's 1 to 2, 1 to 1, 1 to 4, 1 to 7. If I know that the market's going to go from, here to there, then you take the trade. And when I don't know what the market's doing at all, then I have zero risk on. And anytime I'm in a trade, and this is key, I always trade with small enough risk that I can't be hurt greatly. I don't want to trade so big to where if I'm wrong on one trade, I'm afraid to do the next trade, because then you start trading your P&L. And when you trade your P&L, you're psychologically so messed up that you're going to have real trouble holding your winners. You're going to hold your losers too long because you're trying to make money back. You never want to trade with the idea of making money back. What you want to do is trade from A to B, from B to C, C to D. That's all you want to do. You always want to, every trade, whether you started the day up $5,000 or down, $5,000. You have to take each trade in stride as its own trade. Make sure you trade with small enough risk to where you can do that just fine without blowing up your account. And most importantly, when it comes to capital management, guys, yes, you can lever up on A trades. 1, it better actually be an A trade. 2, you only get to trade if you have money. It's protecting your capital stack is so important, especially if you worked on it. You could ruin 20 days of effort in one bad trade. So be smart. You're not special. Promise you, you're not special. I'm not special. Had to learn the hard way. Just be very, very smart about managing your money. Manage it like it's somebody else's money, and you'll die if you lose it. Okay. Hope you enjoyed this video. See you in the next one. Peace.